Welcome, everyone. I am excited, privileged, honored to have actually three very accomplished, I should not use the term, but badass women on the webinar with us today. And they are joining us from across the continent. So we have Rita from our Toronto geography. We have Fernanda from Santiago, Chile, which is Latin America. And we have Charanya from New York. So thank you for being here, all three of you. And just to give you all a bit of an intro, I'm Kush Pujha. I'm the founder of BuyProperly. We're a platform for fractional real estate investing. So we allow people to start investing in real estate with as low as $2,500, which means you're basically buying a share of a house, so to say, and that helps you build portfolio over time. And the reason for that is, and you all are aware because you all live in big cities, is in any big city, owning real estate is a very big deal. If you have even a one bedroom in a place like Toronto, it's $500,000. If you have to put down payment and mortgage, it's just out of reach for regular people. Most millennials and Gen Zs struggle to even think of owning real estate. And that's kind of the problem that we as a platform try to solve, to get people into real estate faster and sooner. I feel like women make even less investing decisions based on a survey and data that we have. And the idea of this webinar was to say, hey, this isn't something that women should stay away from. There are enough women already doing it. This is important part of your living, career growth, and planning your life. And so I think the idea is that we as a platform provide as much information as we can, in addition to allowing you to start early and at a short time. So in terms of just telling the audience who each one of you are, Charanya, we are glad to have you. Charanya is a director at real assets from Willett Advisors, and she's from New York, as I already said. She has experience at CPPIB, so she was actually in Toronto, and we used to hang out at Red's Midtown Tavern once in a while. And she's worked at Credit Suisse, DLJ Merchant Banking, and she, of course, has an MBA from Wharton School and a Bachelor in Economics from Bernard College. So welcome, Charanya. Next, we have Rita Lee. Rita is an investment advisor at RBC Dominion Securities. She has over 10 years of investment industry, working across Scotia Wealth, RB Investment Advisors, PwC, JP Morgan. She has a CFA degree, CFP, and has her MBA from Ivy School. Rita has been helping women on our platform exclusively, so people want to reach out to her for advice. She has offered her time for free. So thank you, Rita, for that. We also have Fernanda with us. Fernanda is the head of institutional clients at MBI Inversiones. I hope I pronounced that correctly. And she has 10 plus years of experience in private equity, investment management, and consulting. She has, of course, worked at Ecus Private Equity, BCG, and Credit Suisse. She also has an MBA from Wharton School and a business degree from Pontificia Universidad Católica, Chile. Thank you, everyone, for being here.
Happy to be here.
So why don't we start with one key question, which is always on people's mind. Why do women not traditionally invest as much as men? And what, in your opinion, is the biggest challenge they face? Charanya, we will start with you.
Yeah, I hate to always go back to the origins of all this, and you guys feel free to disagree with me at any time, but I think it goes back from conditioning at an early age of women aren't as good as math as like men, or like, and then finance is all math, and then all of a sudden you go down this path and it separates, and then making broad generalizations here of women are more risk averse, and women aren't necessarily the ones who are in these roles of being an investor. Now, all of us on the panel all have MBAs, engineering degrees, finance degrees, and all that. So obviously we buck all of those myths. But just to be stated, you don't need an engineering degree or a math degree or a finance degree in order to start investing. In fact, more women, if you took control of your finances from a young age, starting at 18, starting right after college with that first job. I think that can lead to a lifetime of being ahead of others, but I do think it starts at that conditioning at an early age for why women may not be on the same foot as men. But feel free to disagree with me. That was just, I hate broad generalizations, but I couldn't think of anything else.
Rita? Sorry, go ahead, Fernanda.
No, just to piggyback on what Charanya was saying and add up to that is that I think also it has to do a little bit with having less disposable income and saving that disposable income for, not for investing, but for emergencies or house things, or it obviously depends on the stage of life that the woman is on. And then when you go back and you click back and say, okay, but why would women have less disposable income? It also comes to choosing careers, as Charanya was saying, that tend to pay less. I am not sure as to say that generalization that women earn less just because they're women. I'm not sure that is completely true, but I am sure that there are less women in finance, and so for that equal job, there's less women earning more, and having that disposable income that you feel safe to have and put into an investment and not into your piggy bank for emergencies.
Yeah, so just from my observations, I think confidence is key. For women, it's less likely for women to be confident in areas where they're not the subject experts. So sometimes it's kind of like a self-screening process, and that deters women from starting to invest early. And another thing I think that was mentioned by Charanya is maybe it could be an interesting. I've heard from women to say that, I just don't think the stock market or investing is that interesting. And in a way, it is a little bit more abstract, especially when it comes to investing in the stock markets, for example, because it is kind of like a derivative of the actual economy. I think that could be a factor as well. For example, I'm married to, my husband is a software engineer, and I don't think what he, I don't have a real interest in what he does. So that could be a real thing. And lastly, I think there is, it's a generalization, but I think women tend to be a little bit more risk averse. And that can tie back to confidence piece again. To invest in stocks or real estate, you do have to have some optimism in terms of thinking that you have done homework and you think this will pan out for you and make you money. So those are just my general observation as well.
Yeah, I mean, the confidence, I feel, is of course the key. Like you said, there's a lot of stereotypes out there. Like when I am buying my real estate, I am doing all the math, I'm doing all the numbers, and yet my real estate agent constantly would address my husband and would try and convince him. And it took him a really long time to realize that he is the one making sure it works emotionally, and I'm the one running the numbers. Mm-hmm. And like till the end, he was trying to convince my husband why he should pay more or less, but like he just wasn't ready to admit that I am the one holding the number that finally he is pushing for, and not my husband. It's a stereotype, even though I'm driving the number conversation, even though I am the one going with all the math and analysis to him. So there's a lot of stereotypes that probably people need to debunk, which brings me actually to the next question on why women need to get more active and what are the benefits of women investing? Because at the end of the day, while I think Fernanda mentioned that, yes, there may be a life stage or women are trying to take a break mid-career, all of that. But at the end of the day, women are actually often outliving men by 10 to 15 years. So they better plan. So if they take a 3-year career dip somewhere, but have to outlive and be around for another 15 years, they better plan for the next 15 years because they'll have 12 more years to both invest and gain from that investment. It's super important that they get active. So I would like to hear from you guys on like, why do you think like women should be active? In my mind, just because I'm going to be around longer is good enough a reason to plan for it. But and what they can benefit from being actively involved in the financing decisions, because often even when they can, they just don't, just because the society kind of gears you like that.
Happy to respond first on that one. So I don't know about most people's households, but particularly in my household, my mom was the one who did all of our budgeting and accounting, how much we spent on groceries, how much we spent on rent, and all of that. And so this myth persists that women are not good at handling the money, yet my mom was the one who controlled everything. I don't know why it keeps persisting out there, but at least that's the model that I had from my family. In terms of why women should be more active, other than just us living longer and needing to be independent, whatever partnership you're in or family structure you have, I saw this chart the other day, which was if you keep your money in cash or treasuries or just in bank accounts, it will take 72 years. This was a US-based study looking at empirical evidence. It takes 72 years for it to double. If you kept it in the bond market, it will take about 20 to 30 years. If you kept it in equities, historically speaking, it would take 7 years. And so if you switch from just not investing at all and just keeping it all in cash, you're not going to grow it at all, even if it's extremely safe. And I'm not saying you should put everything in equities, but there is some balance between real estate, equities, bonds, cash. There has to be some sort of mix that is comfortable for you, that allows you to grow your money without it just sitting there and not working for you. And this is assuming that you have something outside of just your emergency savings. But even if it starts with that $100 that you have, it's important to start there and grow it over time.
Yeah, so there are so many benefits from being proactive. So, you take active control of your financial future, you have peace of mind and more confidence. From my observation from working with families, generally I find that women tend to be the planners. So they're way more interested in engaging in the financial planning discussion. And the men are way more interested in talking about investment portfolio and rate of return and earnings and get into all of that. To Khushbu, your point, women do live longer, and we know this for a fact. So at some point, I think a lot of women will find themselves to be the sole decision maker on a lot of things, and to start early, it will be, a lot less overwhelming. You're way more prepared. So I think that's really important. And for me, for our children, I have a plan to build their financial literacy, their financial acumen. I want to I have plans to start them on a brokerage account super early so they learn about the markets. So you can do all of that. But being proactive is not just kind of to benefit yourself, but also your spouses, your children. So I just think tremendous benefit, yeah.
Right. So in my case, I'd say, besides the living longer, I think, and Rita touched upon this, financial independence is key, because it lets you drive decisions not because of fear, but because of the real needs and wants that you have. So when thinking about women, that this model woman, Khushbu, that you mentioned before, that does not have access to the real estate market, for example, because a house or an apartment in Toronto is $500K, and you think about that woman, and maybe she doesn't have a very lucrative career and so on, and if you also think that she does not have her own investments, then in her household, she may be taking decisions not because of what she really wants, but because she doesn't have the money to do different things. So I think, Rita touched upon this, but I think it's important, and also like culturally, in Latin America, it happens a lot that women do not have I mean, they have the financial control over the budget, but they don't have the financial control over the earnings. So yes, they are great managers, like household managers, but they don't have the earnings. And then if they have like a husband that doesn't treat them well or whatever, then they're kind of I don't know how to say this, but a little bit helpless. So I think being in investing, even if it's as low as you said, as $2,500. I mean, it's important to do it early and soon.
Yeah, on that note, we actually have an audience question. If you are approaching 50 and wanting to invest, is it too late? If not, what do you suggest for someone who's past middle age? Rita, do you want to kick that one off?
Sure. I think it's never too late. Definitely, if you're starting now, I would suggest to work with someone, you know, to make those important decisions, because you know, a lot is at stake to make the right decisions there. And I think it's super important to have a plan in place. So if you're, say, just past 50, you may be looking at retirement soon. And there are a lot of decisions around how do you look at driving income in retirement. There's a tax planning piece as well. So yeah, so my general advice would be to work with a professional and to have a plan in place. So, you know, you have a roadmap in terms of addressing some of those important questions.
On that same note, always seek more advice. This is just more of a personal note. My grandmother, her husband, my grandfather, passed away when she was 70. She's now 82. At 70, she then all of a sudden had to learn about finances and what to do. So I sat down with her and was like, look, this is how much you have, this is your budget, this is how much you need to live, this is what your retirement income looks like, or this is how you do it. And now she manages an investment portfolio. I'm not kidding, at 82, she's like, I'm investing in these stocks, what do you think? And this is dividend paying stocks, this is this stock, but it keeps her so active. And she's done that over 12 years of learning about it. And so I definitely do not think it's late. At 50, you're only at half your life, like the way that we're going with averages. So you have a long way to live and a lot of planning that you can incorporate in all of that.
Right. Also, I mean, I was thinking, I mean, not only if you're 50, but even if you have 5 more years to live, or 10 more years to live, or 1 more year to live, if you think about it not only on your benefit, but your family's benefit, as Rita said, about children and all, it's important to manage your finances well and to start investing and to make more from your money. I mean, if you let it sit down, as Charanya said, it will just not grow. So not only for favoring yourself, but also for favoring your offspring.
Right. And like, at least from our side, what we can do for all such people interested is we do have a roster of financial advisors that we can connect you to. Rita is one of our esteemed advisors, so you can always email us and we'll connect you for some advice. We do have some more questions on the same line. If you have very little expendable income, how do you start small? How do you what amount do you set aside when you're living paycheck to paycheck? I mean, that was one of the problems that we were trying to solve by keeping the minimum really low, so that even if you have a small amount, you can save $2,000 and start small. It's not about how much you're investing, but getting into the habit, and things change and life is long. And yes, once you have that discipline, it always works. But curious to hear what the three of you have to say about how do you set aside an amount when you're living paycheck to paycheck or have a small income?
I think in that situation, definitely utilize all the tax deferral vehicles like RSP, TFSA, really maximize any kind of tax incentives the government offers, because, you know, every little bit counts too. So definitely maximize that for sure.
One other thing I'd say is if you're in that situation and you have kids, there's also tax deferral assets for college planning. So you can, I know in the US, it's various college plans that you can just set aside money that is very tax advantageous. So you can still save for different ways and invest while you're saving. Those can go into mutual funds and sit there and be different. Same with healthcare plans too. In the US, it depends on which jurisdiction you're in, but you can have an HSA and it can be growing, but it's set aside for health expenses that have tax savings also for you.
Right. I feel it's the question can be separated into one is an asset allocation question, and that asset allocation question you will always find stocks or coupons that are sufficiently low in price, like in the number and the figure, so that you could invest $50, whatever. So that is one thing, and it's easily solvable. But the other one, I have more trouble answering that question, because I think the four of us, we're all like very privileged women that have probably, at least not now, have to live paycheck to paycheck. So it's a really, really tough question, I think. What I would say though is that it's not only like savings has two parts. It's not only about the income, it's also about how much you spend. And I know that sometimes when you earn too little, it must be very difficult to have any control on what you spend. But at least what I try to do, and I've tried to do it all my life, is like live below our means and at much below my means as I can, to generate more of that gap between income and cost and generate more savings. But I understand that it may be difficult and it may not be done in every situation.
Yeah, I like how Fernanda is emphasizing the living below the means piece. I feel like I've done that too. I mean, through college years or whenever I was not earning, and I was spending way less than I could, so that I always ended up with some surplus no matter where I was. I've seen my younger brother do that when he was trying to buy a house. He literally did not order anything online in the COVID era on Amazon for the entire year because he was saving up towards a goal. So I think maybe somewhere having a goal helps, that this is what you are investing towards, or this is what you're saving towards, and this is how it will impact you. But once you have that, then it's easier to figure out ways, whether it's being tax efficient, whether it's being just reducing your spending or figure out cheaper options, all of that. But unless you have a goal that you have to invest a certain amount, you have to grow a certain portion of your wealth always, or keep something aside, it is hard when you don't have a goal or a metric that you're working towards. So that's kind of my 2 cents on how to make sure that you're always managing something. Actually, we have a few more questions on this. There's another one on working professional, and you guys can see it in the Q&A section as well. As a working professional with a student loan, I often struggle with the decision between paying off my loan versus saving and investing. What are some suggestions to approach this, and what should be prioritized? Charanya, you want to kick that one off?
Sure. To me, it really depends on the rate of your loan. Yeah. So I don't know if everyone else is going to say this. My cousin, he was a doctor, and he has medical loans, but the way that his loans work, they're not, like, he doesn't have to pay interest for 10 years and then they're at 1%, and it's just something crazy just because of certain scholarships he had or certain guarantees from the university he went to. So it was insane. I was like, never pay this back. Leave it out there. These are loans you should keep forever. You will always be able to meet 0 interest and 1% interest. So do not ever, like, even if the mental obligation of, oh my God, I have so many loans, that can be mentally heavy, but that 1% in the long term is so little. Depending if it's higher than like 1%, or like it's 3 to 5 to 10 to 12, depending on what era you got these loans in, then I would work towards paying it down and seeing what the market offers you versus that. But maybe others have other pieces of advice like that.
Yeah, I think there are some strategies that are available. For example, and I'm not saying this is appropriate for your situation, but you can borrow to invest, for example. In that situation, the interest expense is tax deductible. And it could be a good strategy for some people, but it could be too aggressive at the same time. So, and just going back to the super low hanging fruit, you know, when you make an RSP contribution, depending on how much salary you're making, it can lower your marginal tax bracket, and you get that tax refund back. And that's added money that you can invest. So there's, you know, a bit of a, you know, compound investing that way. So really optimize kind of, these are the things that are readily available for you, and, you know, understand it well and make it work for you.
I was completely interpreted by Charanya, so I don't have much more to add there than just compare the rates. How much can you make on your investment versus how much the loan is? And maybe also just apply a little bit of context. I mean, if you have too much loans, it may hurt maybe your, I don't know, your score or your capability to have a mortgage, for example. So be a little bit mindful about that. But it comes down to what Charanya said about the rates.
Yeah. I kind of agree with Fernanda on it is, at the end of the day, it's a game of interest rates. Like I had a 7.7% interest for my student loan. So I knew that no matter what I'm doing in the market, that's a much high rate to beat. So I was kind of better off paying off that loan than investing anywhere at that point in time, because it's a fixed 7.7 is a very high return to beat over a couple of years of time. So it is,
and that's 7.7 without volatility. I mean, it's
yes,
for sure, it's certain.
Yes.
I mean, you maybe could think, okay, I'm gonna make 10, but this year and then next year not, and it's tough.
Yeah. Cool. Before we go to another question, one last question on the same one is, if you have been working hard to save and have a good amount of savings, but are not sure where to start, what would you recommend? Around 25 to 40,000 is what the person has saved. Is it real estate, or would it make sense to engage a financial advisor? And the person is saying, so hard to find a female advisor. Well, I run a real estate deals platform, so I might say that yes, real estate, but that wouldn't be true. You, at any given point in time, need to ensure that if that's your total saving, it needs to be diversified across various investing instruments. Real estate being an integral part of that diversification, but cannot be all of your money in only real estate, because it's also illiquid. It's also cyclical. So I would like to advocate all in real estate and all on our platform, but probably not. Rita, you talk about that as well?
You're very responsible, Khushbu. Yeah, so in that situation, I would say, you know, start small and definitely diversify. Because to give you an example, right, in Canada, we often taught that, you know, financial sector, real estate sector, utilities, these are the defensive sectors that, you know, we invest in for someone that's more conservative. And then COVID happened, which no one really foresee the impact of it. And these are the exact sector that were hit the most and had trouble recovering. So there are always things that are outside your control, and that's not foreseeable, really. So that's the benefit of diversification, as Khushbu mentioned. So, so definitely don't put all your eggs in one basket, and have a strategy to diversify across different investments.
One thing I'll just add to that, the easiest way that I always start, I think this is definitely available in Canada, and Rita, I don't know your platform, so please feel free to plug it, but Wealth Simple, you don't have a minimum, they have very low fees or something like that. If you just start there, it's just investing in mutual funds, and you can choose a bunch of different mutual funds and there'll be very low fees, but just getting yourself into stock market, like the S&P 500 or just anything. You can chat with anyone at all times, but it's probably better to go through your banks or through your networks and find a real financial planner. But if you wanted to just start somewhere and do it on your own, something like that may be an easy way to get into equities for a portion of it.
Yeah, and we are the platform for the real estate portion of the diversified portfolio. We also start small, low fees. We do all the due diligence. So we're kind of the other part of Wealthsimple, where we are providing real estate options.
Sure. So I have a bit of maybe a different perspective, and it has a lot to do with this like state of life, maybe. I mean, different stages of life. For like, I think of money as like, there's money that I can use to invest in stock market or liquid financial assets, and then there's money that I use to eat and have a roof over my head and put clothes on, right? So for me, 25, if you would have 25K to 40K, that's it, and thinking that apartments are, I don't know, like what Kushbu was saying, like 500K at one bedroom. Maybe it may be, depending on your income, enough for a down payment. Maybe not. I'm not so familiar with the Canadian real estate market, but for me, putting a roof over my head, if I am sure what is the city that I want to live in, and so on and so forth, depending then in your state of life, it's very important, and it's even, for me at least, more important than making more money on the stock market, for example. Because also, as obviously, real estate also may go down in prices, but if it's the house that you're living in, you don't care a lot if you're not going to sell it at that point, right? I mean, it's a long investment horizon, and having that ease of mind, for me, it's funny because it's kind of a dissociation between not knowing a lot of finance but acting in a kind of different way. But putting a roof over the head, for me, it's very important. So, and 25 to 40K, I think it's maybe a good enough sum to think about really, even if there's no diversification at that point. So that would be my take, that it's a little different, maybe a little bit unorthodox, or not married too much to the financial knowledge, but it's like more emotional.
Yeah, that's an interesting perspective, Fernanda, because you are trying to separate how you use the money in terms of what you're spending on consumption or taking care of yourself versus what you're spending on growing the wealth. And so like buying the house is almost like a consumption good. It's not real estate investing for growth of wealth, but more like, am I better off paying a $2,000 rent, or am I better off moving that to a mortgage and paying a $2,000 mortgage a month? It is the same cash outflow, but here I am overall though still generating equity, and still not only that, making my life better, basically.
Right.
So it's kind of that two-pronged thing where you're using that money towards some of consumption as well, having a buffer, because you never know when something like COVID can happen, things like that. Overall budgeting. I think it's time to move on to the next question, but maybe we run a quick poll before we get there, and then people will have a minute to vote on this. Interesting, a lot of people depend on online research and personal knowledge. Mm-hmm. All right. So this is what it looks like. Okay, 40% of the audience is yet to start active investing. Well, then I guess this is the right session and place to be in, because it already means that you are thinking about it and you can potentially start tomorrow if that's the intent. Awesome. Okay, moving on to the next question. What are some of the common financial mistakes women make, or people who are starting to invest make in general, and how can you avoid them? And what resources can be used? Charanya, you want to start that one?
I think one of the common mistakes is I will get to it one day when I have enough money. That is, I think, the key common mistake. Like, I am too young, I don't have enough money saved, I don't have enough to really invest. I think you can start at 18, I think, or even younger. I think you can start with $50. And so I don't think that you really need to be at a certain age or have a certain wealth or have a certain status in order to get there. So I would say those are my two things.
I think one of the things that I see is investing in the market, for example, has been quite gamified in a way. So everyone, actually, I see a little bit opposite, because everyone believes that they can, just start investing in, maybe the names they like, or something that's, what's trendy and hot right now. I think, when it comes to investing, it is a specialization. And you do there are a lot of different driving factors. You should read the company's financial statement, understand the drivers to the company's profitability, have, a few key themes that to say that this is why I think this is a good investment, right? So do that homework. One of the things that I see that people tend to do is, you have this gamify or a bit of a speculative mentality to it, and that's not very good. I find that. In terms of resources, for people such as myself, investment advisors, we're always eager to show what we know and our capabilities to attract clients, get clients to work with us. So if you want to have a chat to kind of talk us through some of the things, I'm definitely available to talk.
Common mistakes, maybe just like to name three that come to mind. The first one is not being mindful enough of tail risks, and COVID has demonstrated that black swans happen, and you have to have that into your model. Or into your mental model. Also, and connected to that, maybe not knowing well or not investing adequately given your investment horizon, because what has happened with COVID for the stock market, that it has already come back quite a bit, but it's not that important if you're investing long. But if you were investing short, like for a short amount or short horizon, obviously you have to have an adequate strategy for your investment horizon. And finally, being very mindful, as a mistake, being very, very mindful of diversification, but not of correlation. And that is very important, because your portfolio must not be a collection of stamps, of names, like as Rita was saying, like maybe trendy names, but that you don't know why you're investing on them. You also have to maybe run the numbers yourself, or have someone help you run the numbers and see what the correlation is between those financial assets, in order to avoid big crashes. That's three that come to mind.
One thing I'll add, I just saw it in the comments, of avoiding debt. What I would say is there are certain debts you should avoid and certain debts you shouldn't avoid. So when it's your mortgage on your house, I wouldn't avoid it. If it's a student loan and you're investing in your own education and yourself, I would not avoid it. Some auto loans these days, you need a car to get around. I usually don't recommend it, but it's very low rates, and if you need a car and you'd rather not do certain things in COVID times, maybe. Credit card debt, always avoid. Always, always, always avoid. So there are certain debts that are just debts to live a lifestyle that's beyond your means, like certain things. That's what credit card typically lends itself to. So I wouldn't say avoid all debt across the road. It is take debt where it's investing in yourself or your home that you live in or other things like that, and not to fund a lifestyle that you can't yet afford.
Yeah, and I'd like to add some resources around how you can build your knowledge or confidence, because when we started the session, we talked about how lack of confidence is often a reason why people don't start investing, and can also be the reason why people end up making mistakes, going towards trendy names, or having a blanket avoid debt rule, things like that. I feel online, and a lot of people indicated online research is what they do, there's tons of things available. So there are companies like us, of course, who are trying to provide neutral information. We have people like Rita, who are financial advisors. We also have professors talking about neutral information, not trying to sell a certain product, but saying, hey, this is how you actually have a diversified portfolio. So there are a lot of companies who invest in educating their end customers, would-be end customers, but there's also a lot of professors and technical books that you can read. Like if you go on Udemy, you can buy so much for $8, $9. You can learn so much, and it's not biased information. So online information is great, but you also have to make sure that you're getting a full perspective every time you are making an investment decision or trying to get into investing at all. So invest in some of this knowledge stuff rather than just reading blogs and online advertisements. Make sure that you're getting a balanced overall view of investing when you're starting to invest. And we are happy to help, but we are not the only source. There are a lot of companies like us who provide neutral investing information about diversification, about the different products available, in addition to courses available on Udemy, Coursera, all of those things. There are a couple of questions, and I think they are maybe, Rita, you might be a good person to answer. It's about what do you look for in a personal financial advisor? What's important in terms of designation, experience, connection to a bank? How do you vet them?
Yes, so I think maybe the number one thing is you're working with someone that you're comfortable with and you trust, and that's something that sorry, you build up over time, of course, but you have a conversation and, you know, is this a person that's paying attention to what I'm saying and what I need, and really trying to understand kind of where I'm coming from and how I kind of perceive things. I think that's important. And from a more technical perspective, there are lots of industry designations such as Chartered Financial Analyst. You know, it takes 4 or 5 years to get through rigorous exams and experiences, and Certified Financial Planner, and you know, just someone that comes from a strong investment background, so they can guide you through the complexity of everything that's out there. You know, ETF was relatively new a while back, but now there are maybe 5,000-6,000 ETFs out there, and which one is right for you? So I think those are important, and ask them about how they will work with you. What was the plan? You know, I think that's really important to get a good feel of what it's like to be working with the person.
Since we are getting quite a few questions on this, let me run a quick poll on this. But meanwhile, Charanya, Fernanda, I would like to hear from you guys. Are there things that you think somebody should look out for when looking for a financial advisor, and say, if you see these red flags, stay away, or this is not the right time to engage one? In any advice on that line?
I'll go quickly. I don't know if I want to give other panelists a chance to speak as well. I think if it's someone that's very specific about a product pitch, maybe something that maybe maybe a red flag. Make sure that they understand that, you know, you feel like they're working in your best interest. One more thing I forgot to mention, there are certain advisors are tied to specific platforms, for example, others are more independent, and that's something that's keep in mind as well.
Fernanda, Charanya, anything to add on red flags?
No, no. I mean, I would just be interested in know like commissions, like management fees and so on. But not much out there.
Okay, cool. Moving on to our next question. What are some of the easy ways to start investing? Like for people who have not done much investing yet, because we've been talking about this, and how can they manage their finance and investing? Like, how do you ensure that they are doing a diversified portfolio when they are starting out? So yes, they can experiment with the BuyProperly or the robo-advisor and stuff like that, but where do they start really? Like, should they do an analysis first? Should they do a portfolio first? Shana, you want to start?
I feel like Rita's much better equipped to answer this question than I am, but I will start with my own, the way that I did it. So the way that I did it was I looked at my own budget for the year. I made sure I have at least 6 months in savings in cash reserves. So if I lost my job, if something unexpected happened, I do have that savings. And then the rest of it is what I would like to invest over time. And so then I take that number and I say, okay, I would like to invest this for me at my age. I'm 34 and I want to be in equities and more diversified equities over the long term. I'm not buying a house anytime soon. I'm not I don't have significant student debt. So this is my plan. My plan was I'm going to leg into the stock market slowly. So I picked a number, call it $1,000, but I don't want it to be, I picked today and I'm putting all $1,000 in today. So for me, it was every week, I just decided I'm putting in $50. And then that way I'm averaging over time. And I did use a robo-advisor for this, and I am doing it all mechanically. Like I asked TD Bank to sweep a certain amount to my robo-advisor invests that amount as soon as it comes in there. So it's all automatic and just does it without me thinking about it. So that's how I did my own. Not to say it for anyone else, but I just wouldn't pick a random date and wouldn't pick a random stock. For me, it's about getting broad market exposure.
Yeah, so I think the question is maybe twofold, but when it comes to diversification, we would say things because it's easy to say. Because if we say that we want a balanced portfolio, you want some in stocks and some in bonds, and that makes sense depending on where your risk tolerances are. But a lot has happened. For example, right now we know that interest rates really low right now. So to have that back to Fernanda's point of really making sure that you're diversifying, or it's really doing what it's supposed to, and that relationship kind of is breaking down a little bit too. I would say that diversification is super important. Looking at some of the alternative real asset classes, such as Khushbu's platform, it's less liquid, but at the same time, it does have that diversification where given its relationship with the stock market, for example, right? And then lastly, I think if you're Charyanya's grandmother, starting at age 50 or 60, and this is something that you really want to get into, and you have a lot of time and energy to do it, that's to definitely do the legwork and do the homework though. Don't just speculate and say that this is something that I hear on the news a lot about this company and that's what I would invest. Or leverage experts. I think Khushbu does a lot of legwork on her properties and make sure it is a good investment property that you don't have to do, or someone like myself that does the homework in terms of is this the right diversification for your profile. So those are the options, I think. And another thing is I think tax is so important, because in Canada, it's one of the things that just can, it's particularly will go up. and different things such as your salary or rental income, Canadian dividend, foreign dividends, capital gain, capital loss, or if you're earning income from a corporation, they're all taxed very differently, right? So to optimize around that and just make sure that you're optimized on the tax front too, and that really make a difference over time. So yeah.
Right. Just to add, I think it's a great era to be in investing. I mean, it's easy today. It's very democratized. There's a lot of platforms, like for stocks, for example, in the US and probably in Canada too, where you can invest with a minimum amount, and you don't have fees to pay, like transaction fees, and so it is like readily available. But that's also a double-edged sword, because you have to have some financial knowledge or some sense of the investment horizon of your financial goals, etc. I would say before just jumping into investments with just because you want to, not just because you want to grow your wealth, it means that you're actually going to grow it. So I think in that part, there's a lot of information, like data available to do the research. There's the platforms, but you have to be very mindful about thinking first why it is that you're investing, your financial goals, and being sure that you have some knowledge or some sort of someone that may help you in order not to lose those precious savings that it's tough every month to make. So that's what I would say.
Yeah, I like how you all have slightly different perspectives on how to go about it. And thanks for sharing your own experience as well, integrated into this one. To Fernanda's point, there is tons of information out there, including what we disseminate, and it's important to use all of that to make sure that you are dealing with your risk appetite and your personal goals. So coming back to making sure that you know what you want, what kind of goals. Is it more important to have more consumption cash, or is it more important to have more investment cash? Like, what are your goals? What are the things that you want to hit at different points in time in life is probably the first thing. Everybody seems to have a goal towards their career, their job, what kind of life partner they want. But not enough people seem to have a very clear financial goal. Yes, we all want to be rich and have all the money we want. That's not a goal. To having a very clear goal on whether I would rather have a large house or a fancy car is an alternative use of the same cash. And it's important to know what's important to you. Or would you rather be just living in a one-bedroom condo but able to travel the world all the time? So it's, I think, important to know yourself, know your risk appetite, your time horizons, what life events will unfold and how you may want to deal with them, and then see how you build your portfolio to service those goals. Like, money in itself is not a goal. The goals have to be serviced with all the wealth that you're growing. So get the goals right, the time for hitting those goals right, and then plan the portfolio. That's how I think about it, at least. Or when I am thinking about it. At one point in time, student debt was the only thing on my mind ever, because it was the most expensive interest rate debt, and the only thing I cared about was how to get out of it. It did not matter how much I was saving, whether I have a house, rent, nothing else mattered. But then that's changed now, and there are other goals that I work towards. In the interest of time, I think we do have a few more questions, but let me run a quick poll, and then I would like you guys to tell us a little about your own investment and what do you invest in, each one of you. Like your personal investments, you're all investors and very accomplished investors, and you advise so many people. But what's your investment? Charanya, Rita, Fernanda, let's hear you.
Are you gonna run the poll first, right?
Yes, I'm running the poll now. And since you guys are the experts, any tips that you have based on your personal experience? It would be good for the audience to know that as well. I think this is how I invested. This is my logic framework.
Sure, I can say something. So I invest my family's portfolio the same way that I invest my client's portfolio. You know, I'm fortunate in the sense that I'm supported by a lot of investment professionals. We have a dedicated capital markets team, and there are a lot of, you know, between 300 to 400 equity research analysts that follow the companies in different sectors throughout primarily North America, but also globally as well. So making that constant asset allocation decision in terms of where best to allocate the money geographically and between different asset classes. I think just right now in the current environment, fixed income is definitely very challenging. Sometimes I find that, you know, even for more conservative investors, we need to start looking at some of the other options as well. Assets, which does provide more of a diversification to the overall portfolio. So, you know, and other than that, just, you know, constantly looking at the best ideas of given where we are in the current environment and run a portfolio that way.
Well, in my case, my investment portfolio is actually very different than that of my clients. Probably because I had institutional clients, so it's like a very different sort of strategy or investment horizon and whatnot. But I would say I'm very transparent about my family's my household's investments. The first investment has been in education. Getting the MBA is obviously financially demanding. In my case, I got an MBA as well as my husband. We both went to Wharton at the same time, so obviously that was more financially demanding. But we see it as investing in our earning power. So after that investment and coming back to Chile from the US, what we did was buy an apartment. And we were not diversified at all. We were just into one thing, but having that earning power let us save month to month in order to afterwards make another investment in a house and then start a financial asset portfolio. So nowadays, what I would say is that of our family's wealth, it's probably, or household's wealth, it's probably 75% invested in real estate. And then the other 25%, it's about 40% of that is asset-backed private debt. So it's alternatives, but like with low risk and lower return maybe than the stock market. Then 40% is US dollar. Just today, because of the circumstances, US dollar. It's in cash, but US dollar. We live in pesos. We earn in pesos. But today, the political scene in Chile is challenging and volatile. So we decided to start having more US dollars, and just in case. And then the other 20% is in a small stock portfolio that we stocks that we follow, that we're interested in, and that companies that we know. Not many, it's 4 or 5, but it's investing in some stocks we know. So that's very, very directly and very transparently, that's my household's portfolio.
I'm happy to go, but in the interest of time, do you want to move on, or?
No, we would like to know your portfolio as well.
Mine is a bit different. So real estate in New York is just very expensive, and I ran the math on how much it cost me to rent a 1-bedroom apartment and how much it cost me to pay property taxes, condo fees, interest, and maintenance, basically, on just upkeep. All of those things added, those are wasted things. They're not amortization of your mortgage or actually building equity. Those are just things that go away in owning property. All of that always exceeded what rent I could do for a similar apartment. So it did not make sense for me to buy in Manhattan or in New York City, or at least in the areas that I wanted to live at that time. So real estate is not in my portfolio at all. And I think it should be, but it's just not. I do pay the mortgage for my dad's house where he lives in New Hampshire. So technically it's in my portfolio, but I think I'm never gonna sell it. It's my dad's home. So it's in my portfolio, but not really. And everything else is in broad equities. I don't want to stock pick for me. So for me, it is broad market thesis. And that's also because my financial platform my employer doesn't allow me to stock pick. I just have so much red tape and so much other things that I have to do. So I just invest in the S&P 500. I would say that's 90%. I'm also in a private investment vehicle of my company. And so we make private equity investments, and I'm allowed to invest alongside those investments. So I have 10% of my wealth alongside the investments that I make on behalf of my firm.
Awesome. Since everybody's shared, I'll make it quick. I feel like I'm also heavily invested. As you can imagine, I'm a believer of real estate. Spend a ton of time in that space. So yes, a large part of my portfolio, almost 60-65% is in real estate, but I also have a significant equity portion in my overall net worth, and that's probably because I used to work at Amazon before and half my salary was stocks, which got me started in the equity space, and then after that more mutual funds, because I needed to diversify rather than have all equity exposure to one stock, which meant I ended up with a decent equity portfolio. The one thing that's low in my portfolio actually is fixed income. So I don't have as much fixed income in my portfolio as such right now, but I still have some time for retirement before I start moving some of this towards fixed income. I would think between equity and Amazon stock has been good, so no complaints, but between equity and real estate is probably the bulk of my portfolio. I think we are out of time. So for all attendees, if you have any questions, feel free to email us and we will connect you to all the panelists here. We will forward it to them and get you the answers because I think that was one of the questions people had. But given that we are a real estate platform, I would not shy away from letting you know that we are adding a lot of deals on the real estate side. It may look like not the best time, but the suburbs are suddenly really, really interesting because everybody wants to get out of the condo and into the house. And we have a portfolio in the suburbs. So if anybody is interested, I'll run a quick poll so that we can later on help you as well on this. Thank you all for joining our panel. It was very, very interesting to hear your perspectives, but also thanks for sharing your personal stories and your personal investment portfolio. It should give people a sense of what people who are qualified, already doing this as a profession, how they think about their portfolio, how they think about investing in general. We had some great anecdotes around personal consumption, having a roof over your head, a 70-year-old grandmother who's starting at 70 and is managing for 12 years, and how financial advisors work. So thank you all three. And if we get more questions, we will probably forward it to you and hope you would oblige us with some of the answers. Thank you.